Rahul Arora, CEO of Nirmal Bank Institutional Equities, with us as well. Rahul, you would argue, and thank you so much, Rahul, for agreeing to this request, because I know it was a bit of a last minute for you, so appreciate you accommodating this. But it's kind of playing out as per script for you. The Indian cricket team and the markets, both of them are not quite faring as per what people would want.
Morning, Niraj, and thank you for having me on the show. So I think, Niraj, this was, I mean, you've probably heard it enough and you'll probably get bored with my answer, but I think this was long overdue. I think there was a certain reality check that was required in the market. Fundamental earnings growth was never supporting where the valuations were in the first place. And, we saw that beginning with the defense sector about 4 months back. It went on to the EMS side, consumer durables, electricals. It slowly moved into IT services, then consumer staples again after the results, and now it's percolating into auto. So I think you're sort of seeing, Neeraj, as we were discussing the other day on Mohra Trading as well. This is probably the worst earnings cycle that we have seen going into a Diwali in a long, long time. What is very evident, Neeraj, is that the rural economy is in a mess. I think when you have Hindustan Lever coming out with 2-3% kind of volume growth, two-wheeler manufacturers giving you the kind of numbers that they are, DMart just about getting into teens in terms of top line growth, and even certain consumer discretionary plays like PVR. I mean, you look at the stock of PVR today. I think that's also taken a bit of a knock on the chin, despite a big ticket Diwali release. So I think the problem, Neeraj, here is the biggest earnings growth in India over the last 10 years has come in because of margin expansion. And over the last 5 years, because of balance sheet deleveraging. So you've had debt come down, interest costs come down, and therefore profitability growing. From here, I think, Neeraj, the entire onus is going to be on top line growth, and the visibility of that seems to be lacking. And I think the market is now adjusting to that new order reality. I still don't think we're going to fall off a cliff. I still think that somewhere around 22,000 we will find a floor on the Nifty. But I think the move to 26,000 now, from where we began this fall, could be a very challenging one.
22,000 is 2,000 points away, Rahul. So that is actually a worry, because we've cracked 8% odd in a matter of a month and some days. So that's been, as much as people would like to say that it's been a sideways move now, we had a very swift pull back, because not too many people anticipated this in some fashion, even if the valuations were high, because the domestic flows kept on keeping the market afoot. You reckon that that pillar and those numbers will come out in a matter of a few days would be a very important gauge of what the markets do? Because if the retail investor blinks and those SIP flows get impacted, that could be an even bigger problem, if you will.
So I think you've raised a very important issue, Neeraj Bhai. And I think, the point is, a lot of investors who've come in for the first time in the market post-COVID haven't really seen a correction. So I think you've raised a very critical point as to how they react in the face of a correction, because they've just seen the Nifty go from 7,500 to 26,500. So this is something new for a lot of first-time investors as well, and flows will certainly be tested. But I think the fact that you use the word retail, Neeraj, I think, if you look at the defense, infra, a lot of PSU stocks, a lot of these were bought by retail and HNI. There was not a very large institutional holding that, propped up these stocks. Now, the interesting part is all of these results are stacked up in the second half of the result season, starting now to up to the 15th. So it'll be very interesting to see what kind of results they declare and the reaction of the retail side of the market to that, because that is where the maximum ownership is. That being said, Neeraj, I think, while you're saying that, okay, we're down about 10%, but look at the earnings cuts that have happened. I think in some cases, the earnings cuts are 10%, in some cases 15%, in some cases even 20%. So I don't think the market is not doing anything that is not making sense. It's cutting in line with the earnings cut. So let me give you a classic example. IndusInd Bank, right? We cut our own estimates by about 17% for the current year, and the stock was down 20%, and most brokers cut between 15 and 20%. So I don't think what's happening is senseless, for lack of a better term. I think there's a method to the madness. People were pricing in extrapolated growth, thinking that it will keep getting better. but I think a reality check has hit. So I think the one thing also that happened, Neeraj, is, as you went into the general elections, earlier this year in May, I'm guessing the rural spending to the bottom of the pyramid would have begun in March, April. That effect has waned off. Now, there was a fund manager who recently told me, but VMart's results were good. But the counter argument to that was VMart's results were good on such depressingly bad numbers that they should actually have been growing 40-50%. So, I think if you have a situation where consumer discretionary plays are only going to be giving you the kind of earnings growth that we've been talking about, it goes back to the point we were making the earlier, a couple of days back, that, maybe money will keep chasing those and expensive will keep getting expensive. But I think Neeraj, just look at the banking data that came out over the weekend, right? The sectoral deployment data that came out over the weekend. Credit growth is down to 13%. Housing growth is down to 12.5%. Services credit growth is down to 13%. So you are having a situation where credit growth in the banking system is also struggling to just about hold on to teens. The only thing that grew well in the sectoral deployment credit growth was the loan against gold, which grew by 50%. And gold has been a hot topic of discussion across the board over the last 1 month. That's the only thing that actually probably held up the 13% growth. So if banks are not going to contribute, if FMCG is not going to contribute, IT valuations are starting to look expensive, Neeraj. Large caps are now trading at 30 or north, and mid caps and IT are trading at between 40 to 50. You're pretty much down to Reliance having to hold the market because that's 75% of the market. So if three major pillars of the market don't take it higher, it's very hard to make a challenging case for the Nifty to go up. Again, like I said, I don't think the market's going to fall off a cliff. I think flows will continue to come. But I think if the Nifty was to head down to 22,000, and I'm not saying it will, I said it could find a floor there, it could become a fairly more attractive entry point for retail and institutional investors.
To play the devil's advocate, Rahul, just trying to understand, wonder, government spending has trended lower in the first 6 months, arguably the first 7 months of the current calendar, right? Maybe because of various factors, including for whatever reason, but it's way lower than what the averages should have been based on the capex spend target at the start of the year. If that picks up, and even if it goes back to trend from a 50 odd thousand number that they have right now to the 90,000 number that should have been the trend number, does that help capex spends and therefore earnings recover? Trying to understand if what you've seen in the results thus far is a trend which will go into quarter 3 or quarter 4, or is it difficult to say if the government spending comes back?
No, so I think, Neeraj, the finance minister has been very clear in her last 2 or 3 presentations to the country that she expects the private sector to pick up the baton. And I think if you see the rate of growth that she has projected for capital expenditure, it's, sort of been just about in line with what they have actually been doing in the past. She's actually made no bones about the fact that she wants private sector to pick it up. Now, as you rightly pointed out, I think there are political compulsions, and I think some allocations have been made to align states like Andhra Pradesh and Bihar. But I think even if government spending was to revive in a material way, Neeraj, you're talking about these projects coming on stream with a long dated timeline, right? So let's say a chemical company or a cement company announces a 200 or 500 or 1,000 crore capex. Chances are this capex is going to come on stream only 18, 24 months down the line. So you're going to be looking at, revenue contributions only post FY 27, 28. So I don't know whether the market in this environment is ready to digest earnings that far out. So I'll tell you, Niraj, before this correction started, the entire street was on FY27, valuations. Now the point is they've moved literally a year forward, saying, okay, these are the kind of upsides we have on FY26. So it all depends on your starting point. But I don't see a very major revival in capex from the government, and I think the finance minister has made no bones about it. And even if you do have that, it's slightly long dated. But Neeraj, I think the point here being, if you take a look at railways or defense or capital goods companies that are government driven, these have healthy order books even today. It's not like they don't have healthy order books. The question is, will the execution timelines be met? Once they are met, will the government offtake those things that they have booked? And how will working capital and inventory be managed? So all of this, sort of feeds into your ROE, ROC, and therefore into your valuation. So it's a great long-term theme to play, but I wouldn't be too immediately excited, with it as a short-term theme.
Okay. No immediacy. Rahul, 60-second answer if we can. Are you disappointed with the FMCG names? 60-second answer, the way out of time completely. is their lunch. Are other companies, including e-com companies, new age companies, coming to eat their lunch? 60 seconds.
Extremely disappointed, Neeraj. I think there is something structurally changing in the consumer sector. I think Gillette has been a spectacular set of results. P&G was not too bad, but I think if you're looking at consumer as a basket, Neeraj, I would still be aligned towards consumer discretionary, which is hotels, alcobevs, and selectively QSRs. Staples is underweight for me, and we could potentially look at names like Gillette and P&G, which have come out with good results, and the stocks have been rewarded accordingly.
Okay, Rahul, out of time on this show, but would love to do a deeper conversation with you on what the structural changes are underway for the staple space, if you will. They've enjoyed high ROCs over the recent past, and you track it as closely as anybody that I know. Would love to get your thoughts there. But thank you so much for accommodating this interview request today.
Pleasure is mine, Neeraj. Thank you so much for having me.
And that's all at the time that we have, viewers, on this leg of Talking Point.